All right, everybody. Good morning. Everybody's still rolling in here, but let's get rolling. Okay. Big mortgage rate jump week. And what we're going to do today is we're going to look at all the latest data, the market trying to grow, trying to happen. And every time it seems like we're getting some growth in new sales, uh, we get seems like we get hit by a jump in mortgage rates. We started the year, rates were in the low to mid sixes, and most of the thought leaders, the projector folks on mortgage rates at the time were assuming that rates would be falling this year, falling by now, certainly by the end of the year. At the time, I remember people talking about 5.5% interest rates. And here we are in the peak of the home buying and selling season. And rates are 7.3, 7.4. Have not come down. The economy has stayed remarkably strong. And as a result, there seems to be less pressure to cut rates to stimulate growth again. So and some of the inflation numbers continue to be high, and meaning that likely the Fed is going to have to stay tighter for longer, and that it has having direct impact on the housing market. So what we're going to do today is see what we can see already. The rate jump was really in the last week or so. Next Monday's data we'll have the first real noticeable set in there, but I'll show you what we can know, what's happening right now, and we'll dive in. And as always, of course, that's why at Altos we track every home for sale in the country every week, all the pricing, all the supply and the demand, the changes in that data, all the pendings and the sales data, so that we can see exactly as it's happening, so that when you need to communicate with buyers and sellers, you can do so right now. And most buyers and sellers have no idea what's happening in this market. And so, the other interesting thing, of course, is that this right now, the local markets are behaving very differently. And so the story in the local markets is very unique. And so we're going to dive into some of those different local differences today. Before we dive into the data, if you are pay attention to these webinars and to our videos and pay attention to the data, but you haven't yet signed up to use Altos with your customers, with buyers and sellers, with investors, you need to understand how to get the data into their inbox. I want to recommend that you just go to altosresearch.com and book a consult with our team. There is in the chat, there will be Lael and Jeff from the Altos team, who when I every once in a while I'll mention things, and they'll drop a link in there that you can click through to go connect with. So, all of the Altos data in the reports that are branded for you, how you get them into your client inboxes, how you use them in listing presentations, how we convert new leads. There's so much valuable data beyond just the data. So I want to encourage you to go dive in, and I'll show you a little bit of that stuff today. And then if you're new to Altos and to this webinar, if you haven't already downloaded our free ebook, How to Use Market Data in Your Business, I highly recommend you go do that. Just click through on that in the chat, go download that so that you can understand how the same way I talk about the data, that you can talk about the data with your clients right now. So that's that ebook. And if you haven't already gotten that, I recommend it highly. So today we're going to talk about, obviously, the mortgage rate environment. Rates are higher. It's the highest they've been all year, highest they've been since back in like early December, November. And what that means for the rest of the year, 2024. We can see we're going to do inventory, pricing, sales volume, all the things. The local markets are behaving very differently. So I'm going to try to spend a lot of time on the local markets today. And then, as always, when we're talking about the data, I like to frame communicating about the data with buyers and sellers right now. What do buyers and sellers need to know this spring? So those are the agenda for today. Let's dive into the data. So We always like to start with inventory. There are 526,000 single-family homes on the market right now across the country. That's 30% more than last year at this time. It's like 120,000 more homes on the market now than last year at this time. And this was the week last year was the low point in inventory. Inventory has been rising now this year for several months, but last year it kept falling until the middle of April, and then gradually increased through the rest of the year. Last year in September, we can see on this bright red line, I'm going to try to do the little annotation right here. Last year in September, the the um, interest rates jumped from like 6.5 to close to 8. And the at that moment, the inventory started rising again. Inventory didn't peak until November of last year, super late in the year, because interest rates rose super late in the year, rose high super late in the year. So right now, this year we've been on this dark line on the 2024 line. We've been on a rising inventory all year with higher rates staying higher for longer. Rates have just jumped again. So in the next few weeks, this trend is absolutely going to continue. We're going to see inventory rising, and inventory is rising now because obviously, as if rates go from 7 to 7.3 or 7.4, there's people who take a step back, they don't make offers, those houses stay on the market longer, that builds the inventory. So the demand side, demand slows, inventory grows. That's absolutely happening right now, and we can see that. Now we can also see though rising the inventory contributed by rising more sellers than last year. So we can look at that in a sec. I mentioned that uh, inventory and the markets are very different in different parts of the country right now. There are only 2 states left with less inventory than a year ago. And so what we see here, the green states, Nevada and New York, still have a little bit less inventory than a year ago. New York will probably change this week. We'll probably switch to positive this week, maybe in one more week, and it might take a couple of more weeks. But I bet by our May webinar, Nevada is positive year over year because inventory is rising across the country. Now, some markets are rising and they're just coming off the pandemic lows. And some markets like Florida is now 54% more homes on the market in Florida than a year ago. And so the Gulf states, Florida, all the way around through New Orleans and down into Texas, those markets tend to have much more rising inventory than some of the other parts of the country. And we can see that in rising inventory, moderating prices, and I'll show you some of those local markets later. But the thing is that inventory is rising across the country. Some of it is just coming off, like the Midwest, the upper Midwest markets. You could see, only 5% more homes in Illinois, 6% in Ohio. You could see this band of where inventory is rising, but just barely. And then down, of course, down in the southern states where inventory is actually up pretty far. So Florida is higher than pre-pandemic times. There's more homes, and it's really Southwest Florida dominant, but it's all of Florida, but really the west coast of Florida, the Gulf Coast. In Austin has more homes on the market now than any time in the last decade. It's not skyrocketing, but it is relentlessly moving higher. So those are things to keep in mind locally. We'll spend some more time on the local markets in a minute. The big thing to keep in mind here is obviously higher rates are triggering less demand, and so inventory grows. But we can also see new seller growth each week for like 24 weeks now. And this week there's like 30% more new listings than a year ago. And so this was 67,000 new listings this week. that is new listings unsold. So there are also another 20,000 immediate sales that are already in contract. But the 67,000 new listings, what we're seeing here is each line here is a year, and the listing volume jumps each week. Last week's data included Easter, so there was a dip. There's that kind of noise that you see in the chart. The light line from 2023, the light red line, you can see was dramatically restricted all year. And one of the things that prevented us from selling more homes, having more transactions in 2023, was the dramatically restricted number of sellers. That is easing this year. So we are lifting the cap on the total sales that can happen because we have more sellers coming to market. We can also see that the dark red line here is lower than some of these gray lines. So the gray lines are past years. And normally in April and May, we might have 80, 90, 100,000 new listings in a week that are adding to inventory. And this is single family homes. You get more, you get another 20,000 or so condos. And that contributes, if you have 100,000 a week, you have 5.2 million in the year sales. So you can see if we only have 60,000 listings in a week, there's no way you can get to 5 million home sales, which is like the sort of the NAR benchmark number. Because there's just not enough homes for sale. So we have a few more homes for sale that is allowing more sales to happen. Sales are trying to grow, but every time we get the rate jump like we had in the last week, we can see that slow down. And so I continue to be optimistic that we will see 5 to 10% home sales growth in 2024 over last year. So a little bit of sales growth over last year. If you follow some of the mortgage market numbers, for example, the MBA's mortgage sales, purchase mortgage applications. So these are people who are applying for mortgages to buy a home. That has barely started budging over last year. And so sales are growing, but the mortgage purchases aren't growing because there's more cash offers happening now, which makes sense because when it is more expensive to finance, it's more likely that we're spending cash. It's also true that some of the cash-heavy markets, places like Orange County, California, have stronger demand, stronger price appreciation now than in some of the markets that are more heavily financed. So we can start to see the new listings climbing now. And in fact, so this is now the new listings, including the immediate sales. And the immediate sales are, house gets listed for sale. On Wednesday, it takes offers on Thursday and Friday. It goes into contract on Saturday. It's no longer in the active inventory. It didn't even make it a week in the active inventory. It's already in contract. During the pandemic, the immediate sales were the big phenomenon of the pandemic. And in each line here, each bar is a week with the total number of new listings. And so in the pandemic in 2022, there's a vertical line here, and you can see how big the light portion was, how many homes. It was like a third of homes in 2022 that week were going into contract immediately, like a third. Now it's closer to like 1 in 5. It's fewer. But what we can see is that at the far right end of the chart is this week. And there were more new listings this week than in any week in the last year, in 2023. So there are 87,000 new listings. It's a nice jump. And so I'm viewing this as healthy. It is the week after Easter, so it gets a little bit of a boost. But you can see that we've got about 8 more weeks, 10 more weeks before we peak, and then the listings volume starts to decline for the second half of the year. So we have more new listings this week than in any week in 2023, and we have 8 or 10 more weeks of growth. So that really says to me that we have opportunity to lift the supply constraints of last year. So buyers have more opportunity, more selection, more chance to have uh, fewer bidding wars, those kinds of things this year, which makes sense. Like money's more expensive, and so therefore the competition is less. All of those. So, but what we're looking for here is there are some folks who might say, might ask, is it too many sellers? Are we going to get out of balance? What we'd look for there is if the dark portion of the line climbs and the light portion shrinks. The light portion would be the immediate sales. So this would be everything that's getting listed is sitting on the market. And that would be a signal that we'd be getting out of balance with supply versus demand, which would have negative price implications further. As of right now, because we only have 67,000 new listings on the market this year, it's still relatively low. That implies to me that we don't have tremendous out of balance happening. Like we have more listings, and that's good. So I'm viewing this condition as positive for the market, healthier than we were last year when we were so restricted on the seller volume. And then we can do it in a slightly different view. And is the market growing or shrinking? Are we getting more sellers or are we getting fewer sellers? And what we've done here is there's a line across at 0 here. And when the data comes in above that line, this is the market growing. This is more sellers allowing for more sales to happen. You can see all from July of 22 all the way through January this year. Last year was a shrinking market, fewer sellers all year long, and finally we started to grow in January this year. But it looks consistent and persistent. So that's why I continue to think that we have more sellers, we'll have more sales, we'll have sales growth in 2024 over last year, even though the cost of money is keeping that capped way more than we'd hoped at this point. And here's one last way to look at how we know future inventory is coming. We can track the coming soon properties. Now, not everybody does this, and not every property, and not every market, but if we track the number of pre-listings, homes that are marketed as coming soon, they're not actually on the market yet. We can see that we have 35% more homes coming soon than last year at this time. Not as many as in 22. So 22 was the end of the pandemic. Mortgage rates were rising in April. Anybody who wanted to sell in 22 knew they had to get it done in the second quarter. So you could see there was all this new listing volume, all the coming soon marketing, so that because at this peak, right in at July 4th, if you didn't get in by June, you knew like we were done. And so sellers dropped off a cliff in July of 22. And so it looks to me like we may be, by the second half of the year, we may be normalizing, getting into a more healthy market than we've had for really almost 2 years now. And that will imply that inventory will keep growing through the year, because we can see like, especially compared to 2 years ago, we could see that's when the sellers dropped way off, 23, very few sellers, and now we're starting to get more sellers coming back into the market. So that's what the coming soon tells us right now, that the growth in inventory trend looks to continue probably all through the year. And therefore, here's how we project it. So in this chart, each line is a year with the inventory curve. Inventory, bottoms in the first quarter and usually peaks in August or September. But in the last 2 years, we had big mortgage rate spikes in September. So inventory didn't peak until October or November, each of the last 2 years. This year, what we've got right now, the dotted line, is the projection for the rest of the year. Right now, rates just jumped, and because inventory jumps as soon as rates jump, we could see in the next few weeks that this dotted line will probably shift higher because rates are higher, and that therefore demand slows and inventory grows. So we likely to see this dotted line shift higher in the next few weeks when we get latest data in. But right now we're projecting 620,000 single family homes on the market at the end of the year. That's like a 25% growth over last year. That's significant. It is not yet back to the old normal. So the old normal, you can see 2019 at the top of the chart. 2019 had almost 1 million homes on the market in June of that year. A few years before that, like 2016, 15 would have been like 1.25 million. But so we're still way below those numbers. But what the question that we want to know, and people often ask, is when do we get back to the old normal levels of inventory? And the answer is higher rates for longer, so multiple years back to the old normal. What's interesting is that some of those markets, I showed you the map of the country, some of those markets are already back to 2019 levels, like Western Florida and like Austin, and some of those markets are already back to 2019 levels. And so that means we have a much more dual market, bifurcated market than we used to have in the country. It'll be fascinating to see how that normalizes over the next few years as rates stay higher for longer. Okay, let's switch into the sales side, the pending side. We can look at the new contracts per week. So this week, new contracts pending, 69,000 single family homes into contract this week. That is like 7% higher than a year ago. And you can see since in the dark line here is the line each week from 2024, and compare it to the bright red line from 2023. So each week is trying to be more sales. There's a couple of weeks where 23 had a surge in and dips in sales, but what you're starting to see now is, I think NAR reported for February that the home sales were up over last year by like 4% or something like that in the NAR existing home sales data. And so that's here in the Altos data. You can see the dark line above the red line. And March is a bigger spread. So it looks like the March data when NAR, for example, announces that at the end of April, we can see why home sales will be up. People will know that home sales are increasing because those headlines will start to pick up the data that we can see already in the Altos data. So we can see slight growth weekly, but here's what we're going to watch. In the next couple of weeks, if rates stay here 7.3, 7.4, 7.5%, the sales number could drop, and we could go back under the late April, May data from 2023. If that deters buyers enough, we're going to watch this new sales rate, and it could be that this falls back down here, and we have capped it. We can see very quickly in the data. If I look over here in September of 22, that's when we had a big rate jump, and you can see how quickly pendings dropped in September of 22. And so that could happen again in that consumers are very sensitive to the rate change. And when we look at the total contracts for sale, so this is each bar is a week. The taller the bar, the more homes that are in contract that are going to sell. Right now, the far right end of the chart, 4% more homes in contract than a year ago, 4% more sales trying to sell. The light portion of the bar here are the new sales each week. So that's what we were just showing the curve on. And so we can see just barely more than last year. And we know that the new sales are growing also. So this will continue to expand. And we also know that last year's sales rate was supply constricted. So because our supply is elevating, that's going to allow for more sales growth. So right now we have 371,000 single-family homes in contract. That's 4% more than a year ago at this time. Many of those are cash deals. So it's for the mortgage folks on the call. It's why we haven't seen mortgage volume increase yet, and certainly not at a 4% rate. But at least the transactions are happening. We're getting some liquidity in the market and starting to grow. And I anticipate that will grow. But we could see that consumers may indeed freak out at the latest jump in mortgage rates, and that could put a slow on this growth. That that early in January we were looking at maybe 10 to 15% home sales growth. When rates jumped, then that slowed. So we're going to see how that continues. The market is trying to grow here. We can see slightly more days on market. Current average across the country is 66 or 65 days, 66 days. It's slightly longer than last year at this time. And I expect that to continue to grow. But this is also very local and very price sensitive. So I'm going to show you a few of those differences in just a couple minutes on where the price, where days on market is sensitive to pricing and market. Let's switch to pricing, and then we will dive into the local market data. So the median home price of all the homes on the market in the country right now is $447,000, 527. So it is higher, like 4%, 1% higher than last year at this time, just barely higher than last year at this time. And this is the dark line at the top of the chart here that we're talking about. Peak home prices was 2 years ago, and in June, end of June of 22. We have not yet, we didn't surpass that all-time high in last June, but we started on a better curve at the beginning of the year. So prices here, these are slight gains over last year. And we had a little jump this week, but man, that's been narrowing. So as homes are on the market now, they get offers in May, it closes in June. You start to see that sales number in July. And so what we can see now is, as a leading indicator, the gap in the growth in home sales is declining, it's shrinking, and therefore what's happening is we have 30% more homes on the market now. That bigger supply is leading to less buyer competition, and therefore softness in the leading indicators of the future home sales price. And I actually have an error on this chart here. I said home prices 3% gains over 2023. That's from a month ago. It's actually down to 1% now. So that's what I mean. It's shrinking. So a month ago it was a 3% gain, and now it's a 1% gain over last year. And so that's because we have greater inventory. And so what we're looking at is, if you want to think about how to project home prices that will end 2024, we ended 2023 with 5% home price increase. And last year at this time, we could see that growth. And this year, the growth is much smaller. So we're looking at like 0, maybe 1% home price increase. If consumers react really strongly to the latest jump in rates, that could actually dip, and we could be looking at slight negative home price appreciation for the full year of 2024. So it's really something to keep in mind there. And I'll show you a few more of the price indicators here. So let's look at the pendings, the new contracts each week. So 69,000 homes single-family homes went into contract this week. The price of those is $389,000. This is where the sales are happening, and and home prices are up just 1% over last year. The dark red line here versus the bright red line. And in fact, remember, we were just approaching the all-time high in home prices a year ago or 2 years ago, and we are 1% below that right now. So this is just a week. It'll rebound. As you can see, there's a little bit of bounce in the week. I think we will by May, June, be showing a new all-time high in these in the sales prices, but we can also see, I've highlighted in gray here, where those big mortgage rate jumps happened. And we can see exactly when home prices dropped. Like all of the home price drop that was last year at this time happened a year before in June and September when mortgage rates dropped. The first thing that consumers do is they say, well, I'm buying less house, I'm bidding less, and it pushes those really quickly into the data. And we're going to watch in the next week to see, does that happen again? Does it happen right now? Or are consumers more ready for this now? We'll watch. And so as of right now, barely getting any home price increases for the year. And it could go negative if this rate jump really impacts where buyers and sellers are right now. So this is the price of the new contracts each week. So these are the 69,000 homes that went into contract. We can see we had a little bit of growth, and that growth has been compressing this year because rates have stayed higher for longer. And one of my favorite leading indicators of home prices is the percent of homes on the market with price reductions. So price reductions are really telling about future sales prices, because we have, if the home is on the market now and rates jumped and we didn't get the offer we were expecting, next week we say, wow, we haven't gotten the offers. We need to cut our prices to stimulate demand. And therefore, then we do the price cut. Then maybe in May it gets an offer, and that sales close in June. And so those are June or maybe July, and those are June and July sales prices that we can see decreasing now with this price cuts data. There are 32.1% of the homes on the market across the country have taken price cuts. That is, it is not at a scary level, not like high, but you can see each line here is a year, and all the gray lines are past years. So there are more price cuts now than in any April of the last decade. And so that is a signal of future home sales prices weakness. We can see, I've highlighted 22 and 23 here, and in April of 22, the light red line, we could see it starting to really accelerate. Price reductions really accelerating in April. And this was telling us already at April that we were looking at future price weakness. We peaked with price reductions across the country at 43% out here in October, November of 22. 43% of the homes on the market at that time had price cuts. And if you recall, the home sales price numbers, the headlines that were saying year-over-year price reductions, were 6 months out ahead of this. So they were April, May, June of last year. So this number is leading 6 months ahead of where those headlines are in terms of home price reductions. And we could even see it earlier because we had this big rising curve of accelerating price reductions all through 23. The other thing to pay attention to here is in this moment in September of each year, we have, let's see if I can get this guy here. This moment in September of each of the last 2 years, this was that moment of mortgage rates jumped from 6 to 7.5 in 22, jumped from 6.5 to 8 in 23. And to the day, we can see price reductions kick in. Price reduction, and therefore peaked way out here later in the year. So we're watching right now over here, our price reductions going to kick in, and we will see how sensitive consumers are to those price cuts, to the new mortgage rates through the year. So because this is elevated, this is telling me that this is telling us that we have less upward pressure on home prices than we did a year ago. So last year, the bright red line, price reduction is still falling in April, fewer price reductions because there were more buyers than sellers. Inventory was falling, and that was pushing prices up. This year, the opposite dynamic is true. Inventory is building, price reductions are building. So that implies less price strength for future home sellers. So if you have, for example, home sellers that are waiting, that are on the fence, we can use this to say, like, it looks like the best opportunity of the year is right now. Also, we have to price it right, because if we don't price it right, things are sitting around. But if we do price it right, things are moving. And we can show that in each local market. And I'll show you those in just a second. So it's a really critical time to watch the price reductions data with your buyers and sellers right now. Very often the buyers on the buy side will say, well, I've noticed that all these price reductions are on the neighborhood, but you like in your price range, it's actually like the houses are moving in 14 days. So if we want this house, we need to make the offer now. So we can use that data for framing the conversation, because there's a lot of fear in the market. There's a lot of resistance, and pointing the buyers and sellers to the data right now is how we get past that fear. All right, let's switch to let's switch to some local data. I'll switch over here. And I like to, so this is the Altos system. This is our advanced analytics system that I have up, where I have queries that I watch. I have, here's available inventory in Austin. And I know I mentioned that Austin has more homes on the market than any time in the past decade. And here's the past decade of inventory in Austin. And 3 years ago, there were 1,300 homes on the market in Austin, and now there's 8,300. Like, it's dramatically more. You can really see that going on. But what I'd like to start here with, since we were talking about price reductions, is I have a rank chart of all the major markets around the country, ranked by the most price reductions. And it's really fascinating. So Western Florida, Southwest Florida, Western Florida, all of the Western Florida markets. And then, okay, here's Eastern Florida. But we have all of the Florida markets are dominating the price reductions right now. And if we scroll down, we can get down here somewhere. Is Phoenix is in here. Phoenix is interesting because Phoenix usually has about 40% price reductions. During the fall of 22, 62% of homes in Phoenix had price cuts. And so right now it's 44%. It is not as rough as it was at that time, a year and a half ago. But this is a much more normal market for Phoenix. So Phoenix has, I use a rule of thumb, is about 30% of homes across the country take a price cut before they sell. It's a rule of thumb. Sometimes that's intentional. Sometimes it's strategic. Sometimes it's a seller who's like fishing for a great offer. And when the market is hot, fewer price, like some of those fishing sellers get their offer. They have fewer price cuts. And so you could see 2-3 years ago, when the market was hot, only 15% of the homes in Phoenix needed to take a price cut, or 20%, and now 44%. It is a dramatically different market in Phoenix than it used to be. And then once we get down fewer, now we can see other parts of the country, Atlanta and Kansas City, we could see with much more normal levels of price reductions. So that's a rank chart that I keep my eye on every week, because I want to know which markets are shifting. Because 18 months ago, it was the Western US markets. It was Austin and Denver and Boise that were dominating this price reductions. And those markets are much more mellow now than the Florida markets. Perhaps the hottest market in the country is the Boston area, Massachusetts. I have the state of Massachusetts pulled up here. We can see in the market action index, this is supply versus demand, strong sellers market. It's actually climbing versus last month. So meaning more demand and tighter supply. And so in Massachusetts, we can see the impact of tight supply looking at 5 years of home prices. We're at peak here. Remember, the country peak was way back here 2 years ago. And so home price peak in Massachusetts is right now and will continue to climb through June of this year. And we can also see, if we look at the price ranges, high end of in the Boston area, 56 days on market, and anything under $1 million is moving in 2 or 3 weeks. So we can see exactly where the demand is in Massachusetts. Now let's switch that over to Sarasota, right? The opposite side of the country. The market action index is way smaller, way lower, much more balanced, maybe slight seller's advantage, but what we have here is you can see in the longer term, we can see here's the price curve in Sarasota, and this was the absolute peak of home prices in Sarasota 2 years ago. Was this week 2 years ago, and rates were already rising. The brakes were already being hit on buyer demand, especially inbound buyer demand, migration buyer demand. Prices did not recover in Sarasota completely last year, and we are still ticking down right now. And if we look at the inventory levels, you can understand why. So, there was 800 homes on the market, and now there's 5,500. So there's 4, 5, 6 times, 7 times, 7 times many homes on the market now as 2 years ago. And that is having a dramatic impact. You can see all the way back into 2019, there's more homes than there was in 2019, 5 years ago. It really, and you can see it across all price points. We can see 5, 6, 7, 8 weeks of on the market across all price points in Sarasota. And if we look at the price reductions, so now we can see we are at multi-year high in price reductions. So this implies future sales prices are weak in Sarasota. And there is a lot to be said here. And so there's not turned around in these Western Florida markets yet. We think that there's a few things going on. One of the things that's happening in this part of Florida are rising insurance costs. And rising insurance costs, and I was on a call with some Wall Street hedge funds, long short funds, and one of the guys on the call said that his, I think it was somewhere on this Western market, townhome on the water, his insurance that he bought in 2021, his insurance has gone from $500 a month to $1,500 a month. And you can imagine, and he said, I've got a 2% mortgage. I'm never selling this house, but this is a big deal for my insurance costs. And so when that holding cost increases, that drives a lot of the resale inventory. There's a lot of people who say, you know what, now suddenly it doesn't pencil out for me to hold this property any longer. And that drives price reductions up. It drives inventory up. All of those things are coming into play in Western Florida. I often comment that Sacramento is like the national market, only more so. Sacramento seems to be like the most normal market across the country. What I was looking at in Sacramento, and I don't know why that is. Maybe it's because it's a mix of existing and new construction. It's a growth market as inbound migration. Maybe it is those things, but it seems to follow the patterns. And so the pattern is right now, inventory is up a little bit over the last couple of years. So 1,600 up to 2,400, but still below the 2019 levels, right? We're still a third fewer homes on the market than we had across the country in 2019. And you can see price changes in Sacramento, big years of run up. 22 had a big price big price adjustment, but then that prices at this moment in 20 of last year, we could see we could see those, like we saw inventory was still falling. We saw price reduction still falling. So that was telling us that home prices were up for the year. And so now that's a little softer signal, but not really falling, right? So if Sacramento is like the whole country, only more so, it is, you can see softer price signals for the future sales. So like less home price appreciation this year, maybe zero, where last year was like a 5% year. And if we go down into the price range segments, anything under $1 million in Sacramento is moving in just a few weeks. So you can see that there's demand there. You can also see how quickly the consumer buyers and sellers are sensitive to changes in rates rather than the absolute level. So if rates finally tick down back to 6.5 or maybe a little bit lower this year, what we're going to see is these trends reverse. We'll see inventory shrink. We'll see transactions pick up. We'll see those price pressures will push higher, price reductions will drop. And so it's like, it's even just a little bit from 7.3 to back in the sixes to the back into the mid sixes, you're going to see that trend change. I've got a few others up here. Let's look at Chicago. So Chicago is one of these fascinating markets in the Midwest and some of the Northeast that is inventory is barely climbing off of the pandemic lows. So there are 7,000 homes in all of Chicagoland right now on the market. It is just a fraction more than last year at this time, and and maybe 10% more than the bottom of the pandemic 2 years ago. So inventory is just starting to climb. And again, as I mentioned early on, the more sellers, more supply means more sales can happen. And so this growth in inventory is encouraging because it will allow us to allow more transactions to happen. And if we look at the price ranges in Chicagoland, you can see one of these things, an interesting thing that happens is at the low end, where we have small homes that are old homes, 77 years home on tiny little markets, they take longer to sell. And so the peak of the market is in here in the middle, $300,000 to $500,000. And then the more expensive stuff over $1 million takes longer to sell. So you can see exactly where the demand is in the Chicago area. And that's different from, say, a Sacramento or like I have Columbia, South Carolina up here, where we can see, the low end of Columbia. Some of these are new homes, some of these are older homes, but that's where the demand is. Where in Chicago, those older homes are smaller, they're out of date, and they're in not as good neighborhoods, and so they take longer to sell at that range. And while we're looking at Columbia, you can see inventory is up over the last few years, but not yet back to the old normal level, 2,500 or so homes. Let's look really quickly at price reductions here. You can see where 2 years ago, the momentum slowed. And now we can see, a sort of normal level of price reductions in the 30s in Columbia, South Carolina. You can see how that market is settling into a more normal expectation range. Okay, let's wrap there. So we have a couple seconds to make sure we close out any questions in the chat. We have, if you're new to Altos and you haven't yet downloaded the ebook, I highly recommend you go to the link, and they'll post a link in the chat here to use this real estate data in your business, use it in scripts, use it in your marketing strategies. How do you help people understand about how to buy and sell right now? Because they are likely really unfamiliar with actually what's happening in the data. So go grab that ebook. I highly recommend it. As always, if you want to start really communicating with your buyers and sellers, go to Altos Research, book a free consult with our team. I don't have time to get to every local market today, but we can go do your local market at when you book time with our team. We can look at your local market, we can see what the data is saying, and get you rolling in your business right